Let us see the next question. An investment of rupees 1,36,000 yields the following cash inflow, that is profit before depreciation but after taxation. Year 1 to year 5 cash flows have been given to us. Determine, the first question is IRR and the second question is modified IRR considering 8% cost of capital. That is a question. Now friends, of course, the calculation of the IRR is something that you already have done it for a number of times. So over here, objective of doing this question in the classroom is understanding a new concept called modified IRR. How to compute the modified IRR? Why do we compute a modified version of something? Because the IRR is a normal working that we have. Now why there is a need of calculating the modified value of something? That is what we are going to have a discussion over here. Before that, let us have the simple IRR calculation. Now friends, we know that the IRR is computed using trial and error method. So randomly we have to start with any discounting rate, and with that the NPV will be calculated. So over here, we can start with any rate, 10%, 12%, something like that. We can start and we can compute the NPV. So let us answer the question. Heading right down. Calculation of internal rate of return, IRR. In that, step number 1, calculation of NPV at the rate of 10%. So first of all, let us compute the NPV at 10%. Dear students, why 10%? For that, so there is no reason. Randomly, we have to start with any rate for an NPV calculation. And over here, friends, we have to make sure that at the time of final interpolation, the difference between two rates should not be more than 3%. Because this time the question does not provide the discounting rate information. So we have to keep the maximum difference of 3% in final interpolation. So 10% is the rate. First year it is 9091. Second year it is 8264. Third year it is 7513. Fourth year it is 6830. Fifth year it is 6209. Based on that, we have the present value. 30,000 into 0.9091. So 27273. 40,000 into 0.8264. 33,056. 60,000 into 0.7513. 45078. 30,000 into 0.683. 20490. 20,000 into 0.6209. 12418. Present value of the cash inflow is 138,315. Amount of the investment is 1,36,000. So the NPV is 2315. At the rate of 10%, NPV is found to be positive. So let us make the computation of the NPV once again by increasing the cost of capital. Randomly, we have to increase to any rate for the purpose of revised NPV calculation. We can see that the NPV is marginal positive. So let us increase with the lower difference. Step number 2, calculation of NPV at the rate of 11%. Why only 11%? For that there is no reason. If you have an argument that sir I want to take 12, yes. 13, yes. 15, yes. Anything you can take. 30, 40, 60, 30 and 20. Discounting at the rate of 11 percentage. And based on that present value. First year factor is 9009. Second year 8116. Third year 7312. Fourth year 6587. Last year 5935. 30,000 into 0.9009. So 27027. 40,000 into 0.8116. 32464. 60,000 into 0.7312. 43872. 30,000 into 0.6587. 19761. 20,000 into 0.5935. 11870. Present value of the cash inflow 1,34,994. Amount of investment is 1,36,000. So NPV is 1,006 negative. Now we will do interpolation of 10 and 11. So let us see friends. Now at 10% we have found positive NPV, at 11 negative NPV. So now we will do interpolation for IRR calculation, and fortunately the difference is also within 3%. So calculation of IRR 10% and 11%. These two rates are to be interpolated. 2315 positive and 1006 negative. Difference of 10 and 11 is 1, and difference of 2315 positive and 1006 negative is 3321. You take the base of the lower cost of capital. Okay. And we make the computation of IRR. 2315 upon 3321 into 1. 0.70. So internal rate of return is 10 plus 0.7. 10 plus, that is 10.7%. This is the way the IRR is calculated. Now friends, the calculation of the IRR was not the learning point over here. It is only that say before we proceed for the modified version, we make the calculation of the basic thing. Now coming to the modified IRR, first of all, that's why there is a need of the modified version. The reason for that is like this. Do not write anything, let me explain you. Normal IRR calculation, comma, makes an assumption that internal cash accruals can be reinvested at the rate IRR. Now, there are two things that I want to explain you. One is a kind of substantiation that the assumption which has been made is like this. And the other thing that I want to tell you is that why it is wrong to make this assumption. For that, I am taking help of an example that we did earlier. The very basic calculation of the IRR that we did. Everybody please pay attention. I am giving you a conceptual explanation. See, the calculation of the modified IRR is going to be simple. However, why do we compute that is something which is important to understand. Let us refer to an example that we did earlier. Messrs. X Limited is considering purchasing of a machinery, life of which is 3 years. Purchase price of the machinery is 10,000. Cash inflow at the end of each year is likely to be as under. First year, second year and third year. Cost of capital of the company is 10%. By adopting following criteria, decide whether the machinery should be purchased using the NPV criteria and using the IRR criteria. So friends, we made the calculation of the IRR and say based on that, say we have drawn a conclusion like this, that we are able to get a return of 25%, so we can afford the maximum cost of 25%, say in this project. How can we draw a conclusion that say we get a return of 25%? For that, say we can have a cross verification like this. If at all we would have made investment of this 10,000 rupees somewhere else at 25% for 3 years, at the end of the third year, this is the amount that say we could have received. Instead of making investment somewhere else, if at all we invest over here, at the end of the first year, we will get 2,500. That 2,500 is added to 10,000 and again we get a return of 25%. So we get 3,125. These two are added once again to 10,000 and on that we get the return of 25%. So it is 3,906. The total amount of the interest is this plus principal amount 10,000. So we will get an amount of 19,531.25. What do we understand? We understand that say investing that 10,000 rupees somewhere else, what you could have received, 19,531.25. This is the way you can calculate. Now instead of investing somewhere else, suppose you are investing in this project. In the first year you get 3,500. See the cash accrual of the project. Second year 4,250. Again see the cash accrual of the project. And third year 8,750. The amount that you receive at the end of the first year is reinvested at 25%. And this is what you get. The amount received at the end of the first year, second year, and interest of the first year end which you have received in the second year, on all of them you get interest 2,156. So the total amount that you are getting is 19,531.25. So whatever you could have received otherwise, the same amount you receive over here, subject to the condition that the internal cash accruals are reinvested at the rate of 25%. That is what the assumption that the IRR criteria has made. I have tried to explain you that whatever the assumption that they have made, how it is proven. It is proven like this. Investing the 10,000 rupees somewhere else at the end of the third year will fetch you the maturity amount this if reinvestment rate is 25%. If at all you are getting a return of 25%. If you invest in this project, at the end of the third year you will get this amount subject to the condition that the internal cash accruals are reinvested at 25%. That is what the IRR criteria says. Now, once we have understood that, say, this is the way the assumption is made in deriving a conclusion that what rate of return do we receive. Now, the next point comes is that, say, why this is wrong. You can see that, say, in the question they have provided that, say, we are having our cost of capital 10%. So how can you tell us that, say, I am getting 25% return considering this assumption? Because I will be getting a return of 25% as per this calculation, but in that case, say, it is important that the internal cash accruals should be reinvested at 25%. But actually we do not have, say, the reinvestment rate 25%. We have the reinvestment rate only 10%, and that is our cost of capital. That is the reason, so the IRR criteria is strongly criticized when it makes wrong assumption for the reinvestment of the internal cash accruals. That is the reason IRR criteria should not be taken for the purpose of decision making. So we are having a modified version of the IRR criteria. This is the first reason for having the modified version of the IRR criteria. Now friends, one more thing. We understand that, say, suppose there are two projects X and Y. Suppose we have made the calculation of the NPV. For project X it is 5,000 and for project Y it is 7,000. We have calculated internal rate of return. IRR of company X is 15% and IRR of company Y is, let us say, 13%. So now what happens, actually we understand that again there will be a situation like this, that based on the NPV criteria the project Y is better, and based on IRR criteria project X is better. So again over here we understand that, say, since IRR criteria has made a wrong assumption, IRR criteria is not selected for the purpose of decision making if at all there is a conflict in the ranking of proposals. Suppose the cost of capital of the company is 8%. Then in that case, as far as the IRR criteria is concerned, it makes absolutely a different assumption. That, say, the X project internal cash accruals can be reinvested at 15%, even though the company's actual reinvestment rate is 8. For company Y it will be 13%, even though for the company it would be different. And secondly, listen carefully, that, say, at one point of time, how can one company have more than one reinvestment rate? It is not possible that, say, one company can have more than one reinvestment rate. It is not possible. Why it is not possible? Because if at all the company has the option of making a reinvestment of the internal cash accruals either at 15 or 13, then of course it would select 15% the rate at which the internal cash accruals can be reinvested. That is the reason we understand that, say, in this type of situation we take the decision using the NPV criteria. Because friends, NPV criteria makes assumption, listen carefully, NPV criteria makes assumption that internal cash accruals can be reinvested at the company's cost of capital. This is the reason, say, we have a modified version of the IRR criteria. Now, one more reason for calculation of the modified IRR. The one more reason is like this. Dear students, there are very less time we have exceptional cash flow series like this: outflow, inflow, outflow. Or very exceptionally we have a cash flow series like this: inflow, outflow, inflow. Dear students, in this type of situation we have a situation of multiple IRR. Yes, multiple IRR. What does it mean? It means something like this. We will be having more than one discounting rate at which NPV of the project would be 0. So we have a situation like this, multiple IRR. Let us say that this is the discounting rate 10% and this is the discounting rate 30%. So what will happen? We will advise a company, let's say if at all your cost of capital is, let us say 25%, then in that case you don't have to accept the project. And if at all your cost of capital is 40%, you should accept the project. In 25% the answer is no, and in 40% the answer is yes. Why? Because at 25% NPV of the project would be negative, and at the rate of 40% NPV of the project would be positive. This kind of absurd answer that say we may have. Rather we will have in case of this kind of cash flow series. At the same time, friends, we may have say the kind of multiple IRR situation in this way. It goes like this. So what will happen? Again, there will be more than one discounting rate at which NPV of the project would be 0. The discounting rates are, this is the rate of discounting and this is the rate of discounting at which NPV of the project would be 0. So the company would be advised like this, that if at all your cost of capital is 5%, let us say that this is 10% and this is 30%. Your cost of capital is 5%, then don't accept the project. If it is 25%, you should accept the project. So these kind of absurd answers that we have. This is possible in case of the IRR criteria for this kind of exceptional cash flow series. So in order to remove the multiple IRR situation, again we are having say a concept called modified IRR. How to calculate the same, that is what now we are going to discuss. Now we are going to understand how to make the calculation of modified IRR. But before I proceed for that, just would like to clarify that as far as the calculation of the multiple IRR is concerned, it is not there included in our syllabus. So we are not doing a numerical with respect to the multiple IRR. We are just understanding this. Why? Because again it has been provided to us in our module, the multiple IRR theoretical explanation. So this is the theoretical explanation. Of course, I am going to dictate that also to you. And we do not have the numerical the numerical calculation with respect to the multiple IRR. The next point that we are going to focus is calculation of modified IRR. Before we understand the calculation, let us write the things that what we have understood so far, that why there is a need of the modified IRR. Of course, this note which I am dictating to you is say for your understanding purpose. At the same time, if at all there is a theoretical question in examination for modified IRR, these things you can always mention, you can always write in examination. So write down answer MIRR. Modified IRR. Write down first point. Normal IRR calculation comma is making a wrong assumption that internal cash accruals can be reinvested at the rate IRR. Second point, suppose cost of capital of the company is 10% and IRR is 25%. Full stop. In that case, IRR criteria assumes that internal cash accruals can be reinvested at the rate 25%, comma, even though actual reinvestment is possible at 10%. Third point, in case of mutually exclusive investment proposal, comma, projects having different IRR, comma, for that comparison is not logical. Full stop. It is because at one point of time, comma, we make assumption that internal cash accruals of one company is reinvested at different rate. Full stop. Fourth, in order to overcome limitation of wrong reinvestment rate, comma, we find modified IRR. Full stop. With paragraph write down. In addition to that, comma, we understand that for unusual cash flow series, comma, we have multiple IRR situation. Multiple IRR situation. Full stop. For example, so only for understanding purpose, I am writing the cash flow series. Year 0, year 1, year 2. Cash outflow, cash inflow, cash outflow, like this. Year 0, year 1, year 2. Inflow, outflow, inflow. In that case, decision making using IRR is complicated. Remember that it is not like it is impossible, it is complicated. Draw the diagram. So I am dictating to you a note for the multiple IRR also, because that is going to help you in the theory questions. This is the cost of capital and this is the NPV. Again over here it is like this. This is the cost of capital and this is the NPV. That is the way we have a situation of multiple IRR. With paragraph write down. MIRR, modified IRR, will also remove limitation of multiple IRR. We don't have any numerical question because the institute has not included the numerical question for multiple IRR. So the second part of the question, calculate modified IRR using 8% cost of capital. I want somebody of you to tell me that, just a new question, that how can we calculate modified IRR? Anybody can tell me. So friends, over here we will do working like this. The first year cash accrual will be reinvested at the rate of 8% for remaining 4 years. The second year internal cash accrual will be reinvested for 3 years, 2 years, 1 year, and this is the last year cash flow itself, so it is not subject to any compounding. So future value of this internal cash accrual is for example an amount of 2 lakhs. Just I am saying taking an assumed figure. So now what we will do, it is 1,36,000 will become an amount of 2 lakhs after 5 years. So what is the rate at which we are getting return will be calculated as balancing figure, and that is what we understand is multiple IRR. I am repeating my explanation here, students. We understand and say what is the limitation? The limitation is the reinvestment rate. So modified IRR says that what is the reinvestment rate? 8%. Okay. What we will do, we will reinvest the internal cash accruals at the rate of 8%. So fourth year cash flow will be compounded to the fifth year using 8%. Third year cash accrual will be compounded to the fifth year using 8%. Second year cash accrual will be reinvested at the rate of 8%. First year end cash accrual will be reinvested again at the rate of 8%. In short, we will compute the future value of the internal cash accrual. In total, the amount is 1,80,000. So the future value is going to be definitely more than 1,80,000. So let us assume that the future value of the internal cash accrual is 2 lakhs. Now, logically we understand we have made investment of 1,36,000 in the year 0. And we have got an amount of 2 lakhs at the end of the fifth year. So we will just put an equation to find that, say, what is the rate at which we are getting return. 1,36,000 into 1 plus I raised to n, that is 5 years over here, is equal to an amount of 2 lakhs. And that is the way we can make the calculation of the modified IRR. So heading right down, calculation of MIRR. In that write down, step number 1, calculate PVCO. In bracket write down, present value cash outflow. In that write down, it will be calculated using company's cost of capital. Step number 2, calculation of future value of internal cash accruals. In that write down, internal cash accruals will be reinvested at company's cost of capital till end of the project. Full stop. Step number 3, calculation of modified internal rate of return. In that write down, it will be calculated comma using following formula. So we'll apply the formula like this: present value of cash outflow into future value interest factor at MIRR, modified internal rate of return, for n number of years is equal to future value of internal cash accruals. This is the way we will compute the modified IRR. Okay friends, now we are proceeding for the calculation of the modified IRR. That's what we are doing now. And remember one important point friends, in examination Never we have to compute the modified IRR unless there is a specific question provided to us to compute the modified IRR. In any question where the IRR question is there, we always have to compute the IRR. So let us start writing an answer. Step number 1, calculation of present value cash outflow. In that write down rupees 1,36,000, because there is only one cash outflow, that is in the year 0. Step number 2, calculation of future value of internal cash accruals. Let us see how to make the calculation of answer. It is first year, second year, third year, fourth year and fifth year. Year 1 to year 5. 30,000 is year 1 cash inflow into future value interest factor at the rate of 8% for 4 years. So it is 30,000 into 1.08 raised to 4, 234. So it is 1.3605. So 30,000 into 1.3605, that comes to 40815. Similarly for the second year, an amount of 40,000. It is received at the end of the second year, so it is compounded to, that is fifth year end. So third year, fourth year and fifth year, it will be compounded for 3 times. So into FEIF at 8% for 3 years, so it is 40,000 into 1.0823, so it is 1.2597, and so on. It will be calculated for the remaining years. Next, third year cash accrual is 60,000. So it is 60,000 into future value interest factor at 8% for second year. So 60,000 into square of 1.08, 1.1664. For the fourth year, it is 30,000 into FEIF at 8% for 1 year. So it is 30,000 into 1.08. For the last year, it is 20,000 into future value interest factor at 8% for year 0, that is 20,000 into 1 itself. It means that it is not subject to any compounding. So the second year, it is 40,000 into 1.2597. So 50388. For the third year, 60,000 into 1.1664. So 69,984. $30,000 into 1.08. 32,400. 20,000 into 1 will be 20,000 itself. Okay. So 40815 plus 50388 plus 69984 plus 32,400 plus 20,000. That comes to 2,13,587. This is the way the future value of the internal cash accrual can be calculated, and this is definitely for year 5 end. Okay, now step number 3. Step number 3 is calculation of MIRR. For that, say we will use the formula like this: present value of the cash outflow into future value interest factor at MIRR for n number of years is equal to future value of internal cash accruals. Okay, so the present value of cash outflow is 1,36,000 into 1 plus I raised to n is equal to 2,13,587. So it is 1 plus I raised to 5. Okay, because the time period is 5 years. Is equal to 213,587 upon 1,36,000. One plus I raised to 5 is equal to 1.5705. Now we'll make the computation of I as balancing figure. So now friends, we understand we have to adopt the trial and error method for doing answer. Trial and error method. MIRR and 1 plus MIRR raised to 5. Let us assume that the modified internal rate of return is 10%. Why 10% assumption is made? For that there is no reason, we can make assumption for any other rate also. So 1.10 raised to 5. 2, 3, 4, 5. So it is 1.6105. So 1.6105 is exceeding what we require. So the answer would be less than 10%. Let me take 9%. So 0.09. So 1.09 raised to 5. 2, 3, 4, 5. 1.5386. Okay. So we understand that say 1.5705 is falling between these two values. So the answer is greater than 9% and less than 10%. So let us do interpolation of both of them. MIRR 1 plus MIRR raised to 5 for 9% and 10%. For 9% the future value factor is 1.5386 and for 10% it is 1.6105. Difference of 9 and 10 is 1. And difference of these two future value factor is 1.6105 minus 1.5386, 0.0719. Okay. Usually friends, we take the base of the lower cost of capital. So 1.5705 minus 1.5386. So difference between both of them is 0.0319. So this difference is represented by this much change in the cost of capital. So 0.0319 divided by 0.0719 into 1. Logically we understand like this. When the rate of interest increases by 1%, future value increases by 7.19 paise. So when the future value has increased by 3.19 paise, what must be the change in the cost of capital is found as balancing figure. And it comes to 0.44%. So we understand that say modified internal rate of return is equal to 9% plus 0.44%. So it is 9.44%. That is the way we can compute the modified IRR. So ultimately the answer of the question is 9.44%. Now friends, what we have learned from this question, let us just recall it. The first thing that we have learned is calculation of the IRR. That's very simple. This is only the repetition of the things that we have done. But the important point that we have learned is modified IRR. The first thing that we understand is that why do we compute the modified IRR? For that there are two reasons that I have shared with you. One is the wrong assumption which has been made by the IRR criteria, that it makes assumption that the internal cash accruals are reinvested at IRR rate. And the second thing that I'll explain you, that there is a concept or there is a situation called multiple IRR. So in order to overcome the limitation of the wrong reinvestment rate and to avoid the multiple IRR, we are having the modified IRR calculation, in which what we have to do, we are required to compound the internal cash accrual till end of the project, that is maybe 5 years, maybe 6 years or anything else, and we discount the present value cash outflow in year 0. If at all there is a single investment made in year 0, then in that case it does not require any discounting. Then finally we do interpolation for the purpose of calculation of modified IRR.